the bubble is really quite simple. You never have an even increase in the amount of credit in the economy. And, when things look sort of better, banks tend to increase their balance sheet leverage by creating loans, which creates credit in the economy. There comes a point where that gets a little dangerous, and then banks think, well, we've got too much risk on our balance sheet. And the two ways in which they can compensate for that, basically, are to lend money to the government rather than the private sector, and also to increase the rate, the interest rate, which they request private sector actors to pay. And that leads to, if you like, a turnaround in the economy. So, you have an economy which, is expanding, and then suddenly it starts contracting, as it were. Contracting in the sense that because credit is redirected towards government borrowing, you find that the private sector ends up in trouble. Now, this is a cycle of bubbles which has been going on since the 1980s, and particularly none of the bubbles have been allowed to wash out the malinvestments, the zombie companies, the companies which shouldn't survive because they don't actually produce what consumers want profitably. So there's the companies that should get wiped out every time the bubble bursts, as it were. But the bubbles haven't been allowed to burst. Each bubble has fed into the successive one. So each bubble has got bigger and bigger and bigger. And we saw a very big bubble accumulate by the time 2008, 2009, which manifested itself in a property crisis. That bubble was never allowed to burst. I mean, the Fed sat there with its checkbook and said, right, open check. Anyone who needs money, we'll give it to them. And it was followed by crises in Europe. You had Cyprus, you had Greece, you had, all these things started going horribly wrong. And again, the ECB said, whatever it takes. That was Mr. Draghi's mantra. So what we now have is we have the accumulation of all these bubbles into one big bubble. And the symptoms of it are really quite clear. I mean, you look at the valuation of equities on Wall Street. They're chasing the Magnificent Seven, the big tech stock, on a momentum basis, not on a value basis. I mean, if value came into it, you'd be selling Tesla, for example. Donald Trump's turned around and said, I don't go for this climate change rubbish. We're withdrawing from the Paris Agreement. Further, we're going to hit China with tariffs. Where are Tesla made? A lot of them are made in China. That market there is diminishing. That's a stock that should be sold under any normal value judgment. But instead, it's at an all-time high. I think it will be sold. Of course it will. But so you can see that's an evidence of a bubble. There's a bubble, if you like, in the equities. And certainly, given that bond yields have already risen, this means that the valuation basis for the equity market is now more stretched than it was in the dot-com bubble back in 2000. I mean, that's quite something.
The financial system today is teetering on the edge of an unsustainable debt bubble. And while many investors are still focused on the stock market and cryptocurrencies, the real crisis is unfolding in the bond markets and government finances. One of the primary drivers of this instability is the sheer scale of government debt. Many governments, particularly those in the West, are so deep into debt that they have no realistic way of paying it back other than inflating their way out of it. Historically, when governments reach this level of debt accumulation, the purchasing power of their fiat currency is sacrificed, leading to inflation or even hyperinflation. This is precisely why gold and silver become so crucial during these times. The simple reality is that while the nominal price of gold may appear to be rising, what is actually happening is that fiat currencies are losing value. Investors need to understand this paradigm shift. When the general public finally wakes up to the fact that their wages, savings, and retirement funds are being systematically devalued, it will trigger a rush toward real assets like gold and silver. The process has already begun, as seen in the rapid accumulation of gold by central banks worldwide, particularly in China and Russia. China, for instance, has been strategically reducing its U.S. Treasury holdings while simultaneously ramping up its gold reserves. The People's Bank of China, PBOC, has been acquiring gold at an unprecedented pace, not just to diversify away from the U.S. dollar, but to fortify its financial system in anticipation of a global currency realignment. Russia has adopted a similar strategy, using its gold reserves as a hedge against Western financial sanctions. Both of these countries recognize that the current fiat currency system, dominated by the US dollar, is on borrowed time. However, many investors in the West remain oblivious to this shift. Instead, they continue chasing speculative assets like technology stocks, which have been artificially inflated by years of central bank intervention. The so-called Magnificent Seven tech stocks, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, have absorbed much of the speculative capital, driving their valuations to extreme levels. Yet, these stocks are being bid up based on momentum rather than intrinsic value. If we apply traditional valuation metrics, many of these companies are significantly overvalued. Tesla, for example, relies heavily on Chinese manufacturing for its vehicles, yet with rising tariffs and geopolitical tensions, this market advantage is under threat, and yet its stock remains near all-time highs, demonstrating the irrationality of this bubble. Another clear sign of excess speculation is the continued mania surrounding cryptocurrencies. Bitcoin and other digital assets have enjoyed a resurgence, with proponents once again calling for ever higher price targets. However, what many fail to recognize is that Bitcoin's price movements have closely tracked those of high-risk tech stocks. The same investors speculating on Nvidia or Meta are also the ones gambling on Bitcoin, treating it as a high-risk, high-reward asset rather than a stable store of value. If interest rates continue rising and liquidity dries up, these speculative bubbles will burst in unison, leading to massive losses. The real economy is already showing signs of stress, and governments are facing an increasingly dire fiscal situation. The United States, for example, is now running an annual deficit of over $2 trillion, with the total national debt surpassing $34 trillion. At current interest rates, the cost of servicing this debt is becoming untenable. The Congressional Budget Office, CBO, recently reported that interest payments on U.S. debt are set to exceed defense spending within the next decade. This means that an ever-growing portion of government revenue will be used solely to pay interest on existing debt, leaving little room for investment in infrastructure, healthcare, or other essential services. At the same time, Western economies are experiencing stagflation, an environment of stagnant economic growth coupled with persistent inflation. If we strip away the government's manipulated CPI numbers and instead use real-world indicators like food prices, housing costs, and energy expenses, inflation is far higher than official reports suggest. The real inflation rate is likely closer to 7 to 10% annually, meaning that the purchasing power of savings held in fiat currency is being eroded at an alarming rate. Given this backdrop, it is no surprise that institutional investors are beginning to quietly increase their allocations to gold and silver. Gold has historically been a hedge against government mismanagement, and this time is no different. However, unlike in previous cycles, central banks themselves are among the largest buyers of gold, recognizing that the existing monetary system is on borrowed time.
When you think that the behavior of people in that dot-com bubble was absolutely extreme. That's one aspect. Another aspect is the cryptocurrency phenomenon. I mean, Bitcoin, they're going up forever. What are you buying? You're buying some digits. I mean, we had you could buy these sort of I can't remember what they were called, but it was sort of electronic art. It wasn't even that. I can't remember what they called them, but people were paying silly money for nothing, and that's a sign of excess credit. And this is why you have inflation in the system. I mean, by inflation, what we mean actually is a decline in the purchasing power of currency. And that's going to continue. So as to where we are in this bubble, I think we're on the verge of it beginning to collapse. I mean, I think it's topping out. What will make it collapse is the next rise in bond yields. At the moment, having had a bit of a rise, they're consolidating. They've come back a little bit. They will go higher again. And as they go higher, the whole of the credit, the gigantic credit system will come under threat. And the first thing we'll see is that there will be a massive bear market in equities. Lots and lots of money will be lost. And I think we'll also see cryptocurrencies come down as well, because crypto are correlating very nicely with, the Magnificent Seven tech stock. It's quite clear that the people who've been gambling in Bitcoin are the same people who gamble in those stocks. It's like a tech stock, if you like. So I think we're going to see that. That's going to be the first sign of it. But rising interest rates, rising bond yields are basically going to undo government finances big time. because governments, and particularly the United States, with a debt to, with a debt to GDP of around about 125, 130%, and the economy is not being productive. This is the other thing, Lucian. Congressional Budget Office came out with figures earlier this month. It's estimates for GDP and for the deficit. What we're looking at, I mean, realistically, the deficit is going to be about 8% of GDP. They reckon that GDP will grow by 4.5%. Virtually all the deficit is spent into GDP. So what we're seeing is, if you take the government spending out of GDP, the private sector is actually contracting in America. So this is actually, you do the same sum with most of the other G7 nations. And you'll find that France in particular, bad news. Britain, bad news. Italy, bad news. I mean, this is everywhere where you've got these deficits, these nations are going into debt traps. And the biggest debt trap of all is the dollar debt trap. And it's that's going to unwind the entire credit bubble.
As we enter 2025, the global economy continues its volatile trajectory, and all indicators point toward an inevitable reckoning with unsustainable debt levels, weakening fiat currencies, and an evolving financial order. The trends we saw in 2024, mounting inflation, de-dollarization, and growing distrust in central banks, are accelerating at a rate most people fail to comprehend. The very foundations of the Western financial system, built on the flawed premise of unlimited money printing, are showing unmistakable signs of collapse. But while the mainstream financial media remains fixated on the stock market, central banks and institutional investors worldwide are making a decisive shift toward gold and silver. The narrative around the BRICS nations has evolved significantly, with countries like China, Russia, and even India quietly accumulating gold reserves at an unprecedented pace. Many people mistakenly believe this is just routine central bank behavior. In reality, it signals a deliberate move away from dependence on the US dollar. These nations understand that Western fiat currencies are on borrowed time, and they are actively hedging against a financial implosion that seems all but inevitable. Yet the average investor continues to ignore this historic shift, blinded by stock market euphoria and the illusion of economic stability. The fundamental issue lies in the structure of the global debt markets. Government bonds, particularly US Treasuries, were once considered risk-free assets. However, as debt-to-GDP ratios skyrocket beyond sustainable levels, investors are beginning to realize that these so-called safe assets are, in fact, a ticking time bomb. The US government is now running trillion-dollar deficits at a time when interest rates remain elevated. This means that servicing the national debt will require either severe austerity measures, politically impossible, or further money printing, inevitable. When given the choice between fiscal discipline and inflation, governments will always choose inflation. And that is precisely why gold and silver will be the only reliable stores of value in the years ahead. One of the most overlooked aspects of gold accumulation by central banks is the potential for a formal revaluation of gold. Historically, gold has been revalued multiple times to counteract financial crises, most notably in 1934 and 1971. As the credibility of fiat currencies erodes, we may see a similar event unfold, one where central banks deliberately push gold prices higher to stabilize their balance sheets. Many analysts believe that gold should already be priced significantly higher based on the sheer volume of money printing that has occurred over the past decade. If gold were to be fully revalued against global money supply, we could easily see prices exceeding $10,000 per ounce. Such an event would not be without precedent. In the 1970s, gold surged from $35 per ounce to over $800 as inflation spiraled out of control. Given today's vastly larger money supply, the next gold bull run could be even more explosive. Silver, often referred to as gold's more volatile cousin, is poised for an even greater breakout. With a gold-to-silver ratio hovering around 80-1, despite the historical average being closer to 16-1, silver remains drastically undervalued. Industrial demand, particularly from the renewable energy sector, continues to outstrip supply. At some point, the massive imbalance in silver inventories will force a repricing, potentially sending silver beyond $100 per ounce in a relatively short time frame. Despite all these indicators, Western investors remain woefully underexposed to precious metals. The average portfolio today consists primarily of overvalued tech stocks, speculative cryptocurrencies, and artificially inflated real estate. Hard assets like gold and silver make up less than 1% of total financial assets, compared to over 5% in the early 1980s, when inflation concerns were last at similar levels. This disconnect is due to a combination of media disinformation and the psychological bias of recency. Investors have been conditioned to believe that the Federal Reserve can solve every crisis by adjusting interest rates and injecting liquidity into the markets. But what happens when the problem itself is the currency? This is the critical question most market participants fail to ask. The Fed put that investors have relied upon for decades is rapidly losing effectiveness. The collapse of the banking sector in early 2023 should have been a wake-up call. The failures of Silicon Valley Bank, Signature Bank, and First Republic Bank demonstrated how fragile the system truly is. Instead of addressing the underlying issue, too much leverage and reckless risk-taking, regulators simply bailed out depositors and papered over the cracks. Now we are entering an era where these same problems are returning, but on a much larger scale. Commercial real estate is the next major domino to fall. With over $1.5 trillion in commercial property loans set to mature in the next 24 months, and interest rates still significantly higher than pre-pandemic levels, we could see widespread defaults and another banking crisis. The Federal Reserve may attempt to intervene once again, but at what cost? More money printing? Further debasement of the dollar? The Federal Reserve finds itself in an impossible position. If it continues raising interest rates to combat inflation, it risks triggering a full-blown debt crisis, as borrowing costs become unsustainable for both the government and corporations. On the other hand, if it cuts rates, it risks reigniting inflation and further eroding the purchasing power of the US dollar. Recent FOMC statements suggest that policymakers are leaning toward pausing rate hikes, which is effectively a signal that inflation will remain a persistent issue. Remember, the Fed is not in control of inflation. The market is. And as investors lose faith in fiat currencies, the shift toward hard assets like gold and silver will accelerate. A growing concern among precious metal investors is the possibility of another gold confiscation, similar to what occurred in 1933 under Executive Order 6102. While such a drastic measure may seem unlikely in the modern era, desperate governments have been known to take extreme actions when their survival is at stake. The good news is that physical gold held outside the banking system remains one of the best ways to preserve wealth under any financial regime. Silver, due to its industrial applications, is less likely to be targeted by government confiscation. This makes it an even more attractive investment for those looking to hedge against systemic risks. Additionally, silver's affordability compared to gold makes it an ideal asset for everyday transactions in a post-fiat world. The reality is that we are living through one of the most significant financial transitions in history. The US dollar, once the unquestioned global reserve currency, is losing its dominance. Inflation is not transitory, it is structural. The purchasing power of fiat money is being eroded at an accelerating pace. And yet, most people remain oblivious to these dangers, lulled into complacency by manipulated markets and government propaganda. Gold and silver have stood the test of time as true stores of value. They have preserved wealth through every economic collapse, every hyperinflationary episode, and every financial crisis in recorded history. As 2025 unfolds, those who position themselves correctly, by accumulating precious metals before the panic sets in, will be the ones who not only survive, but thrive in the new financial era. Western investors may continue to ignore the signs, but central banks, billionaires, and sovereign nations are preparing for what comes next. The only question is, will you be ready?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.